Future-proofing means preparing Africa for tomorrow's challenges today through sustainable, inclusive systems that adapt, withstand, and transform. It's about shifting from aid dependency to African-led solutions. From climate volatility to health emergencies and market instability, resilience is now core to development strategy. It's not a sector, it's a mindset. We do this through investing in homegrown innovations, financing local institutions with flexible capital, scaling social enterprises and infrastructure that serve the bottom of the pyramid. The 2025 AVPA conference brings together voices shaping Africa's future. Investors, policymakers, and entrepreneurs come together to align capital with context at scale. You can expect sessions on climate finance, social enterprise scaling, regional policy alignment, blended finance, and many more. Join us on 3rd to 5th November 2025 in Nairobi, Kenya. For more information and registration, visit us at www.avpaconference.africa.
Good afternoon, ladies and gentlemen. Thank you for joining us for this fantastic, what promises to be a fantastic discussion. Just for some housekeeping rules, you're more than welcome to interact with us as we go through the webinar. For any questions that you might have, please feel free to take advantage of our Q&A portal, as well as our chat. Or you can send those questions through on email. We're very excited to host you today. Our convening today is set on the backdrop of what you will have just seen, which is our AVPA conference. We meet at a moment as a continent of both urgency and possibility. Africa faces a profound financing gap in order to meet our sustainable development goals. Estimates put that financing gap in the hundreds of billions of dollars annually. At the same time, enormous pools of domestic capital sit on the continent. Development actors and market participants now point to the trillions of dollars of local capacity that is on the continent. And this is held by pension funds, sovereign wealth funds, insurers, as well as banks, that if mobilized differently, could unlock vital infrastructure, energy, and social service financing gaps. So why is this capital not already going where it's needed? The answer is perhaps very pragmatic. It is a significant mismatch between where the assets sit today and where the risk and returns are created. In many markets, pension funds, pension assets remain concentrated in government debt or short-term instruments. For instance, some national pension systems still allocate a majority of their portfolios to sovereign paper rather than long-term infrastructure or climate investments. And recent regulatory and currency policies in several countries also restrict offshore novel allocations. At the same time, the reality of the capacity gap that persists on the continent, the trustees, the fund managers, and the asset managers often lack the experience, the deal structuring tools, sharing mechanisms that are needed to convert these promising opportunities and projects into pension-grade investments. These governance and capacity constraints have long been identified as barriers to scaling pension engagement in sectors like infrastructure on the continent. This webinar is by no means an academic exercise. It is a practical convening that is aimed at aligning a clear mission, surfacing the structures, the regulatory changes, and the catalytic instruments that can shift institutional portfolios from passive reserves into active drivers for development. We'll look at three things today. Real examples of how catalytic capital and blended structures have de-risked instruments and investment opportunities anchored by institutional investors like pension funds and sovereign wealth funds. We'll look at the policy fixes and the trustee level evidence that can unlock more approvals into these investment opportunities. And thirdly, we will explore one or two pilot vehicles that can be designed to pursue and to be more demonstrative of how we can mobilize more of this pension and sovereign wealth fund capacity in the next 24 to 36 months. If we leave today with a sharper understanding of the structural solutions, clear asks of regulators, defined pilot designs, and a short-term understanding of the anchor pilots who can underwrite these initiatives for us, we will be moving further from a conversation to action. Ladies and gentlemen, let's get to work. I have the pleasure of introducing our panelists today, who will unpack this discussion with practical views and examples. I will welcome Mr. Dave Oduanu to kindly introduce yourself, followed by Mr. Fola Fabule, Mr. Ngatia Kirungi, and Dr. Frank Aswani. Kindly introduce yourselves and tell us why the work you do is so critical to today's discussion. Over to you, Mr. Oduanu.
Thank you, Precious. And thank you for inviting me to this webinar, and thank you to the AVPA team. My name is Dave Oduanu. I'm the CEO of Access ARM Pensions. We're Nigerian based, Nigerian license, and we operate a pension fund in Nigeria. We manage about 4 trillion, which is just under $3 billion in pension assets. We've been in the pension system for a couple of years. Just by way of introduction, ARM Pension is a member of the Access Group. We've grown by a series of mergers and acquisitions over the last 7 years to create what is now the second largest pension fund in Nigeria. This will be okay.
Thank you for that introduction, Mr. Oduanu. Mr. Fola Fabule, over to you.
Thank you very much, Precious. And thank you, everyone that is attending. Lovely to be here with you all. My name is Fola Fabule, and I work with the Africa Finance Corporation. I'm responsible for the Financial Advisory Services Department of AFC. AFC, we are now a $15 billion financial institution that is focused on financing infrastructure across the continent. We are owned largely by African capital, including African pension capital. And the reason why we find forums like this extremely important to discuss is because our stakeholders, our most important stakeholders, our shareholders, are all increasingly pension funds and sovereign wealth funds from across the continent. We have experienced a significant amount of success in mobilizing domestic capital across Africa. Pension investments from Southern Africa, from East Africa, from West Africa. We have achieved significant success in mobilizing pension capital into the equity of the Africa Finance Corporation. And this is extremely important to us as we catalyze the financing that is required for large-scale, long-term infrastructure projects with significant development impact across the continent. And I'll be delighted to talk to you all about some of the work we're doing in this area. Thank you very much for having me.
Thank you so much, and thank you for that introduction. Mr. Ngatia Kirungi, over to you.
Thank you all. My name is Ngatia Kirungi. I am the Chief Executive Officer of Spearhead Africa Asset Management. and the head of the Secretariat of the Kenya Pension Funds Investment Consortium. At Spearhead Africa, we've been working with local pension schemes here in Kenya to help with their investments into alternative assets, primarily infrastructure. And we are doing that through our asset management arm, through one of the funds we have recently launched or about to launch, which is the Spearhead Africa Infrastructure Fund, which is essentially a collective investment scheme that essentially entails investors getting units in exchange for their investments. And then we would then go out to provide local currency debt to East African infrastructure opportunities. The fund is locally regulated by the Capital Markets Authority here in Kenya, and giving local investors a sense of comfort around our operations and governance and the likes. On the wearing my KEPFIC hat, KEPFIC is essentially an association of local pension schemes that have come together to jointly assess and invest into these alternative assets, including infrastructure. And these are pension schemes from every sector in the economy, from both the public and the private sector as well, who all share a common mandate, like all pension schemes do, which is to essentially grow members' funds in anticipation of providing a dignified and decent pension plan at retirement. And just like Precious has mentioned, we are in this position where a lot of the pension schemes are heavily concentrated in government bonds, and hence there is a need to diversify, but not just for diversification's sake, but to diversify into viable, attractive opportunities that tick the boxes of what institutional investors are looking for. Happy to be here. Looking forward to the conversation. Thank you.
Fantastic. Thank you, Mr. Kirungi. Dr. Aswani, over to you.
Thank you, Precious, and thank you to all my fellow panelists. So it's a real pleasure to have this conversation. I'm Frank Aswani. I'm the CEO at AVPA. This is of significant importance to us and in line with our mission of increasing flow of capital into social investments in Africa, with a view of trying in the short term to address the SDG financing gap. We inevitably have to look at how we unlock more domestic private capital for impact. Firstly, because we're not going to achieve the SDGs or build sustainable growth in Africa without private capital. And secondly, I think with recent geopolitical headwinds and other factors, it's become more imperative that we look internally for capital instead of always being dependent on capital from external sources or external countries. So this is a really critical conversation. At the same time, a very responsible one, because pensions are people's savings, and how do we do this responsibly going forward? So I'm hoping that that by the end of this call, this webinar will have made some good strides in understanding how to both take care of people's pensions, but also see how we can unlock some of this for the greater impact and growth that we desire on the continent.
Thank you very much, Dr. Aswani. I'll start the conversation by getting into the minds and into the thinking of the pension funds that we have represented on the call today. Mr. Odwanu, the ARM pensions in recent times has reported a growth in investments into digital infrastructure as well as operational expansions. Can you describe some examples of the unconventional and alternative assets that the fund has invested in, how you've deployed these funds over the last 3 to 5 years, and what the rationale behind these deployments has been?
Okay, thank you very much. So a company, ARM, it's a major of Access Pensions and Pension. Both companies have been in the last 15 years. We collectively, I say, manage just under $1 billion. And I hope you can hear me well.
We can hear you. We can hear you. It's a little bit strange, but we can hear you.
Okay, all right. And we've invested across the so by asset allocation, we've reduced our investment in, just about 5% now. And our friends started a couple of years ago. We invested in 3 funds. Some of most of them are operated regionally, very largely SMEs and business in Nigeria and Africa. We've also invested in 2 infrastructure funds that launched in Nigeria. One of it is investing in roads, and one is invested in.
Mr. Oduano,
Yes.
sorry to cut you there. Would it be possible to drop your video for the time being to see if that improves the sound quality on our end?
Okay, so is it better?
That's much better. Thank you.
Okay, all right. So invested in 2 infrastructure funds. One is investing in 2 roads, student hotels, and student accommodation across the country. The other one is largely invested in power infrastructure, which you know very well, the ARM Harriet Infrastructure Fund, and is now raising the second fund. We've also invested in 2 real estate funds, the Actis Real Estate Fund and the ASA Real Estate Fund. And finally, we first invested in infrastructure debt funds, and we're evaluating opportunities in private credits. So by way of strategy, our strategy allocation is to invest up to 20% of our assets under management in alternative investments. And, so we're looking to do more deployments in infrastructure, in, private equity, and like I said, in private credit. We haven't done a lot in venture capital and in the traditional impact investment space, but we believe that every investment in alternative investment in Africa creates impact, because these are companies that are growing, and they're employing a lot of people and employing, women and finance education. We're quite excited about opportunities presented by Mission 300, which is a movement or initiative of the World Bank and African Development Bank to electrify 300 million homes in Africa. And we are looking to deploy more assets in renewable energy, particularly mini grids and connected mini grids, and also in power infrastructure. I think our major constraint is that we cannot invest through a fund. We don't deploy capital directly in private investments. And so we do need managers that are credible, that have the experience, that are able to take these assets from us and deploy them in the real sector. But I would say that we're excited at the opportunity to partner with other pension funds and the other PFIs like AFC and to find alignment and common interest on how to work together. Thank you.
Thank you for that, Mr. Oduano. It's very encouraging to see that you've committed to up to 20% of your assets under management being allocated to alternative investments. Institutions like AU, NEPAD, and ourselves would be absolutely delighted to hear that, because for the last decade or so, the campaign and the mission has been to understand the rationale behind the pension fund allocations, but certainly to motivate for more allocations into sectors like infrastructure, to move from the typical 1 to 2% to the 5 to 10% in assets under management. So it's really fantastic to hear the bold commitments that you're making as a fund. Now, pension funds must always balance the fiduciary duty as well as the development impact in where you put your investments. How does Access ARM evaluate risk return for the alternative investments that you've mentioned you've invested in, and you're committing a further 20% into investing in, to ensure the trustees and the regulators that such allocations protect both member interest, but still at the same time driving development impact? Mr. Oduano.
Thank you very much. That's a very good question. So, we see private equity or alternative investment as a way to deploy capital to the rail sector. And, so return expectation is similar to what we'll expect to invest in equities of listed companies or unlisted companies. So when we look at it from 2 points of view, from a currency standpoint, when we do dollar funds, we like to see a hurdle of 8% and a target return of not of 16%. When we do Naira investment or local currency investment in Nigerian currency, which is the Naira, we like to see a hurdle of 15% and return not of 25%. This aligns with the current inflation and inflation expectations. In Nigeria, inflation is trending just around 20% in local currency, and therefore anything not of 20% sounds attractive. And mind you, we have a benchmark, and some of the benchmark we use, unfortunately, are public benchmarks in the bond market and in the listed space. And the other thing we look at is ability of the managers to exit the position. One of the challenges with private equity alternative investing in Africa is exits. Exits are challenged because capital markets are constrained, and the typical strategic buyers, some of them have withdrawn from the continent due to the geopolitical alignment going on globally. So we like to see vehicles or companies or funds that are able to show clear exit routes that we can return monies to our pension fund. We also like to see self-liquidating instruments. That is why we're interested in private credits, either infrastructure or private credit in companies. We like to see self-liquidating instruments. We like to see dividends from these companies being returned. And at the end of the day, we like the funds to achieve a return that rewards the managers with a carry so that they are incentivized to set up other funds and continue to invest in this space.
Thank you for that, Mr. Aldwanu. You mentioned some key aspects there. The need to have a fund manager that knows what they're doing, that is trustworthy, is a critical component of where you allocate your money. I'll pull in and I'll reference your earlier point and your openness to work with institutions like AFC. Mr. Fabule, the Africa Finance Corporation has been a pioneer in terms of innovative finance instruments. I mean, you've tapped into Islamic finance, you've tapped into the pension funds, and I'll reference in the recent years a $100 million equity commitment from South Africa's Public Investment Corporation, which is the asset manager of the government employee pension fund. Could you tell us, walk us through some of the specific transactions and structures that Africa Finance Corporation has undertaken over the last 3 to 5 years, an understanding of some of the key instruments that have worked for you to be able to unlock all these different pools of capital, Mr. Fabule?
Thank you very much. Thank you very much, Precious. I think the first thing to say is that we're very proud at AFC to be one of the more successful African institutions at mobilizing pension capital, particularly pension capital for infrastructure. Just to give you some context, as of the end of 2024, which is the most recent audited financial statements that we have, AFC had about $4 billion in equity capital. So of the $15 billion in total capital that we are working with across the continent, across more than 40 countries in Africa, about 4 billion of that is equity capital. Now, most of that equity capital comes from Africa, and about 10% of that amount comes from pension funds in Africa, pension investors in Africa. And this is all stuff that has been achieved over the last few years. When AFC was first founded, primarily the private sector component of our capital base came from banks, African banks, and originally Nigerian banks. And then we brought on board central banks. The Central Bank of Nigeria was an anchor investor. And then the Central Bank of several other African countries, central banks of several other African countries have joined our shareholding. But over the last, say, 4 to 5 years, we're seeing a significant momentum in investments by pension investors and also by sovereign wealth funds joining the equity capital base of the shareholder base of the corporation. Now, to your question, how have we been able to, or what kinds of instruments, what kind of structures are we putting in place that is making it possible for us to domestically mobilize these resources for making infrastructure investments in Africa? I think the first thing to say is that pension, particularly pension and sovereign wealth funds, which are the topic of our conversation today, investors of that nature, they are looking for an asset class that is very easy to understand, an asset class that is safe, that is well understood, that is easy to predict, and that's what AFC offers. AFC maintains one of the highest credit ratings of any financial institution on the continent, and that credit rating speaks to the rigor in terms of the corporate governance of the institution, in terms of how we organize ourselves as an institution, in terms of how we manage our affairs and how we do business, in terms of the standards that we hold ourselves to, in terms of capital adequacy, in terms of non-performing loans, in terms of risk management, in terms of mitigating risk inherent in the infrastructure investments that we make. And the market has since recognized that we are able to effectively mitigate the risks of doing infrastructure development and financing in Africa. And that does allow us to successfully mobilize a lot of capital domestically from pension and sovereign wealth funds. Now, in addition to mobilizing this capital domestically, we are also mobilizing capital from across the world, from a broad range of investor categories. You won't be surprised to know that some of the things that the domestic investors are looking for are the same things that the international investors are looking for. So they're looking for safety, they're looking for a company that is easy to understand, instruments that are easy to understand. They're looking for an organization that is extremely well run. They're looking for corporate governance that is of the highest standards anywhere in the world, really. And I think that this is really a message or a lesson for the rest of the continent, for the rest of the institutions on the continent that are trying to mobilize capital. So whether from domestic sources or from international sources, the first thing really, over and above, how clever the structuring of the instrument is, or what kind of risk mitigation structures we're utilizing, or how are we utilizing blended finance and concessional finance, and all these clever structures that we talk about, and hedges, and what have you. All extremely important. I don't take anything away from all of that, but I think fundamentally it's about that corporate governance, that transparency, and that having an institution that is easy to understand and easy to predict.
Thank you for that, Mr. Fabule. You mentioned a very critical aspect of why we find ourselves where we are in terms of how much is invested in infrastructure, especially from pension and sovereign wealth funds, which is the aspect of risk. The reality is for the continent that the perceived risk versus the actual risk when it comes to infrastructure is a huge disparity in the middle. Reports show that our default rate as a continent when it comes to infrastructure investments only sits at about 1.9%. Compared to other regions of the world with much higher percentages. Tell us a little bit more about what de-risking tools you've seen work that have made AFC so successful in attracting the pension and sovereign wealth fund capital, especially to asset classes like infrastructure.
So infrastructure financing is risky. There's no doubt about that, right? And it's risky all over the world. It's risky in Africa as well. However, it's extremely important in getting into this line of business, which is something that AFC figured out from very early in its life, that you have to be set up for this business. So we are specialists in infrastructure finance. It is not one of the things that we do, it is the thing that we do. And so the entire institution is organized around how do we manage the risks of doing this business in Africa. So whether it is in terms of the people that we hire, whether it's in terms of the partnerships that we form, the relationships that we have in all of the African countries where we do business, whether it's in terms of the technical expertise that we have in-house and the technical partnerships that we maintain with third parties, whether it's in terms of the way we structure our transactions, the level of local market knowledge that we insist on having before we make investments, the relationships that we form with sovereign partners. AFC is set up as a multilateral financial institution, and so a key aspect of what we do is having relationships and partnerships with governments in the countries where we operate. Those relationships are contractual because these governments sign up to a treaty when they join AFC, and that gives us certain benefits, immunities, and privileges, and what have you. But beyond these contractual relationships, there's the actual personal and professional relationships that are formed with local partners in all of the countries where we operate. So we're extremely local in how we operate. We are working using platform entities that themselves are very large enterprises in the countries where they're operational. So, for example, the platform that we work with for building special economic zones is itself one of the largest companies in that category on the continent. The platform that we work with for doing renewable energy is itself probably the largest company doing renewable energy business on the continent. So we focus very much on building strong, resilient platforms that are imbued with all of the technical expertise and the capital base to be able to manage the risks of doing business on the continent. And I have to say that our experience has been mostly positive. Our non-performing loan ratio is one of the lowest of any financial institution that you will look at on the continent. You reference very low default rates for infrastructure in Africa. Yes, it's true, because African projects generally have to jump through much bigger hurdles in order to receive capital. We experienced this ourselves as AFC when we started our journey of raising capital internationally. So a lot more is expected of you as an African issuer. And so you have to go through hoops that others don't have to go through. And that ultimately leads to lower default rates. So market expertise, local knowledge, and being organized specifically for what we do, I think those are some of the sources of competitive advantage that we've been able to develop over the years.
Thank you very much for that response, Mr. Fabule. It's really echoing the reality on the continent in terms of the importance of building the right relationships, the importance of being strong, formidable organizations on the continent that are trusted with these pools of capital, pools of funding. The element of collaboration ties really well to the KEPFIC model. So I'll shift to you, Mr. Kirungi. The KEPFIC model is a very practical approach to pooling pension funds, pooling the capacity, an ability to really look at investable opportunities. What, in your view, have been some of the most important lessons with this model in terms of persuading multiple pension funds, different expectations from trustees, different risk appetites? What have been some of the biggest lessons around the KEPFIC model? Mr. Kirungi.
Thank you. I think first things first, as much as we have very different pension schemes, they all have the same ultimate goal, right? And so the aim is to preserve capital of members' capital and to grow it prudently, and taking very, let's call it, appropriate investment decisions to get there. One thing that most of the pension schemes have in common is that they're also ultra conservative, as they should be. I think that the expectation that pension schemes would be anything else might be a bit unrealistic. Remember, they are managing, not their own money, they are managing people's money. And as such, it's kind of understandable as to why they would be very conservative. That being said, the CAPFIC model really was one that was based upon doing two things. First, it is building the capacity and the understanding of the local stakeholders, right? And that includes the pension scheme trustees and everyone in the system, in the ecosystem. And that's really from the simple perspective that you're unlikely to invest in what you don't understand, right? And in many cases, this is not going to the extent of trying to make pension trustees infrastructure investment experts, but rather to familiarize them with this new or relatively new asset class as a whole. And one of the lessons that we took away is that when you get that done, and that's always a continuous process, it is then now important that the mode of investment matches what the pension schemes are familiar with, right? And those are those are usually two different formats. One is the use of capital market instruments. That's where we saw the greatest success in terms of mobilization. And secondly is to rely on third-party experts. Just in the same way that today the pension schemes will hire fund managers to look at their equity and bond portfolios, it should be no different when looking at infrastructure. So if you can combine the two, that's now where we have seen significant progress. I would say maybe the last point there is that it is really not, I think it's really on the shoulders of those who are looking to raise capital to match their offering with where the pension schemes are. It's not very helpful to bring to a local pension scheme an opportunity that was designed and structured for an international DFI, for example, because you'd find that there are different elements that each investor type weigh more heavily than others, right? So one size doesn't fit all. To the project sponsors out there that are looking for funding, you'll find that the most successful are the ones that sit down with the local players, understand what they're looking for, and then structure their opportunities to meet those requirements.
Making the right ask, right? I like that you referenced, some of the instruments that you've seen that have been relatively successful in the market. You've mentioned capital markets. Could you please tell us about, some of the product innovations that you think could realistically mobilize large ticket pension fund allocations in the context of making the right ask to a pension fund?
Yeah, sure. I think it goes back to my earlier point on what we have seen, what works. So I'm not telling you what I think, I'm telling you what we have seen. And it is, using instruments such as infrastructure bonds, instruments such as REITs, if you're looking at real estate, or INVITs for infrastructure, essentially infrastructure investment trusts. And one thing all these capital market instruments have in common is that they can be listed. And from that listing, it gives the investor base the opportunity to trade in and out as they wish. Essentially, through a listed instrument, they can risk manage for themselves, and they don't have to face the whole proposition of having their funds or having their capital tied up for a 10 to 15 year period, which realistically just doesn't work for a conservative pension scheme that's looking into a new area. So essentially using such capital market instruments is definitely the way to go. The investors are used to the capital markets. It brings, beyond that tradability, it brings an extra layer of governance and oversight, which is very, very welcome. And it provides the answer to the question that was not the question, but the point that was being made, I think, earlier by Dave, about how they're looking at self-liquidating instruments, or instruments where they can essentially have a view of their exit.
Thank you for that, Mr. Kirungi. I'll shift gears a little bit. So as the AVPA, we are at the intersect of the full continuum of capital, right? We work with diverse pools of funding, from venture philanthropy to institutional investors to, pension funds, sovereign wealth funds. From that vantage point, Dr. Aswani, where do you see the most significant misalignment when it comes to the communication gap between the impact investing community, leaders of pension and sovereign wealth funds, and how can we bridge this understanding of the opportunities in between? Dr. Aswani.
Thanks, Precious. I think if you look at the general communication that goes on around the perception around impact investing, I'm in the UAE, and I've just had a meeting this morning, and we're managing those same perceptions everywhere. And one of the perceptions we had to deal with now that is very consistent with what we hear everywhere else is a perception that impact investment is almost philanthropic in its nature. And I think we've got to keep reminding people that this is about making investments that are very deliberate about delivering both financial returns and social impact. So that's the starting point, is just creating more clarity around the role of impact investing and what it's about, and how do we build more sustainable models in that regard. Secondly, I think what's also really helped us kind of align with private capital and also pension funds is the fact that when we solve and fall in love with the problem we're trying to solve, you get a lot more allies than if you go in driving a particular solution. So in the case of pension funds, I think what's really helped alignment is the conversation, for example, around youth unemployment, and the fact that at its current rate, and if it continues the way it's going, in the next 15, 20 years, it could threaten the sustainability and existence of pension funds. Because we're not going to be getting enough contributors to pension funds. I was talking to someone a couple of months ago who was telling me that for every pensioner they pay out on the other side, or who attains the retirement age, they've got to recruit 20 new contributors. And our Gen Zs are not necessarily plugging into pension funds as quickly as we want them to. So we realize that we're solving for the same problem. On one hand, we're trying to make sure that we can maximize the demographic dividend and address youth unemployment. On the other hand, for pension funds, this unemployment is becoming a business risk. So how do we work together by just making sure that we're falling in love with the right problem consistently? So I think that's the other reality. The other thing that to think about in here is we're in a really tight space as a continent. We've seen the recent aid cuts. Our governments are frankly broke in many of the countries you look at, and we're adding 1 million people a month to the continent. There's a lot less money to go around for a lot more people. And the only way we can actually close that kind of gap of sustainable growth is to bring in more private capital and specifically more domestic private capital, more so listening out to the recent geopolitical headwinds that we are seeing. The sentiments are very much out there that we'll have to depend a lot more on ourselves, and that conversation cannot be held outside or exclusive of pension funds. So I think it's a much bigger discussion, and one of the things I've kind of also picked out is pension funds in many African countries are recognizing that they have clout. They have a lot more weight than they imagined because of the size in which they've grown to. And so they can have very different conversations and negotiations with governments when it comes to those kind of discussions. So basically, that's kind of the things we're trying to do to close the misalignment.
Thank you for that. So I'm keen to unpack a little bit the point that you've raised. So as an alliance that is focused on practical action as AVPA, based on the understanding and the many conversations that have been had around, the need to mobilize more pension fund capital, the need to breach the SDG financing gap, and the reality of the cost of inaction, what specific replicable financial structures or partnership models has AVPA recognized that could particularly be effective in mobilizing, sustainable funding to social impact sectors across Africa?
Yeah, so a couple of things. First of all, I think building on what Ngachi was saying, that pension funds will only invest in stuff they understand well. We've seen some good progress in certain countries where there's a deliberate effort to educate pension funds on impact investing and the opportunities therein. So I think, and this is consistent with what we see across the continent, impact investing is the uptake has been slowed down by just the unconscious incompetence around not knowing what you don't know around impact investing. And we've seen in certain countries, I think we've seen some efforts in Ghana where they've been deliberate in training trustees around impact investing. And that's kind of made some good progress in that direction. I know Hamdia and the team there is doing some pretty good work in that direction. So that's the first thing. The second thing is the whole thing around all concerns that any private investor would have, the issue around risk. And if you think about closing the SDG financing gap, we need about $250 billion a year compared to the $2.4 trillion of dormant capital on the continent. So it tells you we're not short of money. What we're short of is risk capital. So how do we go around raising more catalytic capital or risk capital that will de-risk social investments? And that's why AVPA, we've been very deliberate with doing some work in that direction. We launched the $200 million catalytic fund last year. At UNGA last week, under that same umbrella, we've launched a mental health investment fund, catalytic fund, and it's all about increasing the amount of catalytic capital available to help de-risk social investment, so we can crowd in private capital and make pension funds a lot more comfortable to invest in them. I'd like to see us elevate that to get our governments to think like catalytic investors. And we've seen certain countries where governments have given guarantees to pension fund investments. So those kind of things that I think are the kind of stuff we need to be looking at. But in the same regard, we're also seeing some efforts from pension funds. So there's an initiative in Kenya from APTAC called the Park Hunters Club, where pension funds, recognizing that they need to do a bit more in alternative investments, have said, why don't a few of us come together and pull small amounts of capital into a common fund that can then test alternative investments? So I think there's also been some initiative with pension funds recognizing that they need to be a lot more present in the alternative investment space. So the Park Hunters Club is one where pension funds have pulled small amounts of money, and they can test a couple of interesting investments in the alternative space. I think the first one they've put some money into is in Islamic finance. And so that is encouraging to see that pension funds are also taking the initiative to drive some of this direction and unlock a lot more money for alternative investments. And only after kind of the proof of concept have been achieved can they confidently go in with a lot more and bigger investments.
Thank you for that, Dr. Aswani. When we talk about, barriers to scale and the understanding that, there are pools of capital that are available on the continent, the understanding on the importance of aligning the ask to the pension funds that we're making them to, the importance of understanding the risk aspect on the continent, but also the opportunity that exists. It'll be interesting to learn from you, Mr. Aldwanu, when you look at barriers to entry, barriers to scale, what operational and market reforms would accelerate further than that 20% commitment that you've made as ARM pensions? What operational and market reforms would further extend the ability of pension funds to allocate more to alternative asset classes in Nigeria? Mr. Odwanu.
Thank you very much. So I think first of all is the allocation. And the regulator have done something to expand allocation or the upper limits. Before it used to be 5%, but now it's much more than that. So that's first thing. Second thing is people talk about education, but it's not really about, we don't have trustees in Nigeria because we are fund managers ourselves. So unlike skill in Ghana or Kenya, where you have to go to trustees, we don't go to trustees, we take decisions ourselves. So it is the upskill the fund managers to have portfolio managers who are skilled in alternative investing, because traditionally most of the portfolio managers are focused on listed equities and government bonds. So it's to upskill the teams so that the pension funds then hire more managers who are experienced in investing in alternative assets. I think it is to have many more actors. So I see the alternative investment space as an ecosystem. We need to have many more actors, many more funds, fund managers across the value chain, early stage funds, later stage funds. We need to have growth equity investment funds. We need to have private credit funds. We need to have infrastructure funds, real estate funds, and housing funds. For instance, housing is a space that is huge in Nigeria and can take in loads and loads of capital. But we don't have a dedicated housing fund in Nigeria, different from real estate funds. Housing funds in new cities and large developments. We need to have funds who are focused on, exit, who are buying or secondary markets who are buying assets from existing private equity funds, either fund mandates or assets from private equity funds to unlock liquidity for investors. We also need to have pre-IPO funds. Now, pre-IPO and funds that are interested in taking companies to the stock market are very much needed. Last year, earlier invested in a credit guarantee company in Nigeria called Infra Credit, and it was a pre-IPO investment. The company is now listed. Infra Credit unlocks, provides, security or insurance to pension funds and other investors to enable them invest in infrastructure. And we see it as a market infrastructure company that enables investments in infrastructure. So you need many more of these players. You also need a bit of understanding from the members that own the pension fund. There's a bit of short-term liquidity and short-termism in looking at fund returns. Sometimes in Nigeria, funds are measured on a daily, weekly, and basis. People are interested in how their fund performed. When you invest in alternative investment, you have a lock-up period, and the J-curve effect means that in the first few years, your returns are low. So we're working with the regulator to see how to, sort of address this. And one of the ways is to get funds to publish 3-year returns rather than publishing daily, weekly or monthly returns. So, and I think finally, we just need an ecosystem that works, because you need a deep bench of managers. For private equity and alternative investment in general and infrastructure, you need teams that have experience in adding value to portfolio companies. One of the things we've seen is that some are good in raising capital and making deployment, but they're not very skilled in adding value to portfolio companies and working with management teams to scale those portfolio companies. And I think I will end by saying that, we also need large companies. We need a considered effort to create large companies on the continents. We have too many fragmented industries. We have too many companies that are operating at subscale. So we need private equity funds that are able to do buy and build to scale companies in an industry. What we have done in the pension space, where we grew from just under $500 million of AUM to just under $3 billion of AUM over a 3-year period, is evident what you can achieve if you want to scale. We need those companies to scale in pensions and insurance, in food processing, in power plants. And this is where we need to bring pension funds and other long-term investment funds to support the growth of such initiatives. So I think that it's just a whole number of things that we can do to crowd in more investment in the alternative space.
Thank you for that, Mr. Aldwanu. You mentioned a case study and a reference point that I think for most of us on the continent have been looking to, especially when it comes to local currency financing, which is, the success of InfraCredit and, the involvement of the Nigeria Sovereign Investment Authority and other partners. When you look at catalytic capital in practice, right? How do you, as not the trustees, as the fund managers, as you've made us understand, how do you as a fund manager define catalytic capital in the pension fund context? What does it need to look like in structure, in pricing, in governance for it to be credible and attractive to you as a fund manager?
Well, I think catalytic capital is essentially capital that enables further capital to enter a space. So for instance, if you are deploying, I mean, the DFIs enter the space by saying they are providing catalytic capital. So they write a $50 million check, and that $50 million check then crowds in another $200 million. That is a capital that catalyzes an investment. Also, institutions like InfraCredit are providing catalytic capital because the guarantees they provide enables pension funds to invest at scale to crowd in other long-term investors. And finally, blended finance, where I think firms like African Development Bank, FSD Africa, are providing first loss to funds. I think ARM Harrods have such an instrument, and a few other infrastructure funds have such an instrument where they are providing the first loss capital, which is a risk mitigant to enable pension funds to come into the fund. So in a sense, catalytic capital is required on the continent because a lot of the players on the sideline are not investing, not because they don't understand the instrument or the risk, but because they are not willing to take the risk. So when you have catalytic capital that enables them to take the risk, I think we'll crowd in much more investments on the continent. I think that we like to see catalytic capital that provides a floor. We're not, to say that Access ARM, we understand the risk of alternative investment and we take calculated risk. So in many ways, those catalytic capital works, but it's really not essential for us to make that investment. But there are many other players who require catalytic capital. And, so we like to see catalytic capital that is long-term. There's also a bit of scale in the catalytic capital. But we like to see risk sharing. We don't want a situation where the upside is completely capped, because otherwise, might as well be buying government bonds where the upside is capped. So we like to see some risk sharing, but some upside within the fund. But more importantly, the catalytic capital has to be done that it supports impact investing, either in infrastructure or in housing or in just growing the economy through provision of employment at scale. And again, I touched the point of scale because oftentimes this catalytic capital provided by DFIs tend to be invested in soft-scale industries initiatives. So if you take renewable energy, a lot of the renewable energy initiatives are really, quite a number of them, except a few, are really small investments. And they can't move the needle in terms of providing the required power. So we like to see those catalytic capital that will support large-scale investment in power and power infrastructure on the continent to make a difference in economic outcomes.
Thank you for that. The point that you raised around in your previous response around the need for specific funds or instruments focused on specific asset classes, it sounded somewhat like an invitation to the Africa Finance Corporation, Mr. Fabule, for you to think about, what other platforms you can make available, what type of structures can be made available for people like Mr. Aldwanu to be able to take advantage of at the fund. Mr. Fabule, could you tell us what new platforms or aggregation models you think that would be welcomed by the Africa Finance Corporation in terms of, partnering to scale domestic institutional capital? And what further role do you see pension and sovereign wealth funds playing in anchoring such platforms?
Well, I think we ought to fully utilize the platforms we have already. I think AFC is a great platform, and I'll invite Mr. Udwanu to become, through your pension fund, a shareholder in AFC. I think that is a win that is already there to be taken. We already have Nigerian pension funds as part of our shareholder base, so we welcome more investments from Nigerian pension fund administrators in the equity of AFC. It's an investment that has proven to be extremely successful for all of the shareholders that have participated in it from scratch and continue to participate in it. Now, in addition to AFC's own capital, AFC has put out platforms like the Infrastructure Climate Resilient Fund, which is effectively a private equity fund structure that utilizes blended finance, so some concessional finance in there and first loss mechanisms are included in there as risk mitigant. That has also catalyzed investment from pension funds, including Nigerian pension funds that have put capital committed capital into that fund that AFC is a manager of. And there are other similar structures that we are working on putting together. Increasingly, our pension fund partners are co-investing with us also in some of the portfolio companies that we are building across the continent. So relying on our capacity and our expertise in creating these companies and then coming alongside us for the journey in growing these businesses, these infrastructure businesses. And indeed, some of our international equity partners are becoming shareholders in AFC for this very reason, so that they can co-invest with us in the platforms that we are building. So we think that there is more than enough already available to participate in, and we want to maximize on what exists already. We don't just build new platforms for the sake of it. There's a lot that already exists and that can be tapped into.
Thank you for that. I'll lean on a point that was raised earlier. So on the one side is the school of thought in the reality that there's a lot of capacity that needs to be built on the continent from the fund manager perspective, the asset managers that have the capacity to deploy to sectors outside of, the government bonds. You referenced the unique skill set that Africa Finance Corporation has built that makes you a trusted partner on the continent when it comes to deployment of even institutional money, pension fund money. What, in your view, is the importance of building the relevant and needed deal structuring capacity on the continent to be able to look outside of the infrastructure asset class? So you've got healthcare, you've got education, you've got agriculture on the continent. What is the importance of building that skill within the fund managers and the asset owners that have these reserves and the deposits of pension funds on the continent to be able to deploy to these other sectors?
I mean, it's technical expertise is the most important thing in the investment business. So industrial expertise in understanding the sector that you are facing. So it's it goes without saying that it's invaluable, this expertise. By the way, in response to your previous question, I should mention that InfraCredit was discussed earlier. And that's a platform that we are also a significant equity investor in. And so Mr. Oduano and AFC, we are already co-investors in the platform is good to note. But the idea is to continue to build those types of relationships. To your present question, the first thing is always finding the technical partners, finding the sponsors, finding the groupings that possess the expertise to be able to truly affect a problem. So whether that problem is in healthcare, whether that problem is in agriculture, whether that problem is in infrastructure, there will be a partner that exists that possesses the technical expertise. And it's always about partnering with them. Pension fund managers cannot be experts in every vertical, and I don't think they ought to aspire to be experts in every vertical. Indeed, it is debatable whether they should be experts in anything at all, or whether they should be generalists that focus on managing pension capital, which is an expertise of its own. And so really the skill set is about finding the right partners, the partners who have a proven track record. It's just like making investments in listed equities. You research the company and you figure out which company has proven over time that it does have the capacity to deliver results, and then you make an investment in that company. So I think it's the same. And if there's any expertise that is truly needed, it's that capacity for pension asset managers to be able to determine what is the right partner and what are the terms of the partnership that they ought to enter into in every sector that they want to engage in.
Thank you for that, Mr. Fabule. Dr. Aswani, I'll come back to you. When you think about the intersect between, the regulators, the asset owners, and, the rest of the players in between that are either looking for additional funding from pension funds and sovereign wealth funds, when you put yourself at that vantage point, what would be the three asks to policymakers, to pension funds, to trustees, that if we are to see a change in allocations from the typical 3 to 5% to 10%, and even the bold moves that were mentioned by Mr. Udwanu earlier to go up to 20% in allocations, what would be the three asks that you would make that you think and you feel strongly would shift the percentage of allocations in the next 24 to 36 months?
Thanks, Precious. So a couple of things. I think the three asks for me would be: one, catalytic capital. We need to increase the amount of catalytic capital available, because that would, in essence, de-risk these alternative investments and incentivize pension funds to invest a lot more into some of these opportunities. And I want, because also in so doing, we will then be able to also make capital markets work for the broader communities and a lot more people. So I think catalytic capital, and for me, it would also, I'd like to see African governments involved in that space as catalytic investors. They are the largest holders of grants in any country. And I think that's what they should try and do to kind of build their own economies by unlocking the domestic private capital. We've seen some growth from the outset. So we've seen, like, I'm sure some people who've been following closely have realized people like JICA have now committed to becoming catalytic investors, which is great. So we're seeing a lot more money that we used to come in as aid coming in, more seeking, kind of playing in that impact investing space. So the trends are definitely in the right direction, but we need to do more. And that's why AVPA is very focused in growing catalytic capital. We're also growing the capabilities of catalytic investors. So we've been running, we just ran a training program on catalytic investing, which we had over 60 organizations join. We'll be looking to do this again. So anyone who's interested in that, please get in touch. So that's the first thing. The second thing I think would be looking at pension funds. How can they, in some areas actually, there's an allocation already approved by the regulators and the policymakers. They're just not maximizing it. So how can we work together once we get the catalytic capital, to help them move closer to the upper limit of that allowance? That's one of the things I'd like to see. And then the second thing I'd like to see, once again, kind of 2B with pension funds, is to learn from each other. So, like, I think the pooled fund process that, like, the Kenyan pension funds and the APTAC have adopted of the Park Hunters Club, I think is a really cool one that more pension funds in Africa should try and do. So how can more of you get together, put your money, a small amounts of money, where you can test, for example, some of the things that you would not be willing to do on your own. So we keep talking about needing big investments to make on the continent. But I think as Africans, we'll have to take responsibility to move some of our mid-sized investments to become big investments in the next 3 to 5 years. So maybe that kind of pool fund structure could help in funding some high potentials, mid-size opportunities and get them to really large-scale opportunities where we can confidently put in more money in days to come. So I think the pool fund mechanism for me is really interesting. It enables us to test our investments in smaller opportunities, but also scale proven ones where possible. And then the third thing for me would be to policymakers would be, all these conversations we're having are about helping countries broadly in doing things like creating jobs and stuff like that. So for governments and policymakers, two things I'd ask for. I think, once again, governments should really consider themselves as catalytic investors and come into the play of seeding or contributing to the larger pool of building catalytic capital. And secondly is how do they kind of provide an enabling space through policy reforms that make it easier for allocations to be increased where they're lower, but two, innovative financing to thrive and grow. So in some cases, for example, you'll see we need some policy changes to allow foundations, for example, in outcome-based financing models to be, or blended finance structures to be able to participate both as investors and outcome payers, not just as outcome payers. So I think there's a lot of scope. The good thing is that in all of these things, there's a lot of upside. If we can get some of this stuff done quickly, we can move much faster.
Thank you for that, Dr. Aswani. Happy to open up to questions from our audience. I know that there's quite a few questions that have come in. And in the interest of time, it would be great to be able to cover some of those. So this is a question to Mr. Ngatia. How do we address the need for mid-sized industrial funds? The main thing that is needed in Africa is funding for projects in the range of 1 to 10 million euros to make things like food processing plants and other small-scale local industrial production. Over to you, Mr. Kirungi.
I would say, first of all, there are plenty of these mid-sized industrial funds that are looking at our market and that are looking to raise capital from the pension schemes to various degrees of success. So I think there isn't a lack of those types of opportunities. The challenge becomes, are those types of opportunities what are right for the pension schemes, or are they structured the way the pension schemes want? I would just, just say, right off the bat that from our experience, the whole LP-GP structure, so limited partner and general partner type structures and, long-dated funds, our market is not very keen on that type of structure. Hence why I keep harping back on capital market instruments. So, in my opinion, where there are those opportunities that those types of funds would invest in or would find attractive, those should look to come to the market directly where possible, either through IPOing or through issuing bonds. And if you have to go, and I believe this is the right way to use a third-party expert manager, let that structure be one that is listed and works for the pension schemes, right? That's the general view, not just for mid-sized industrial funds, but really just for any opportunity that you'd like the pension schemes to participate in.
Thank you for that. An additional question for Mr. Oduanu. What mechanisms can protect pension funds from inherent risks of impact investing and ensure capital preservation? That's an interesting one. Mr. Oduanu?
I think the simplest is blended finance, first loss capital, and mitigants or guarantees. So when we invest in projects that are brought to by infra credit, we have a downside risk protection, and therefore the risk of loss is transferred to infra credit. And when you invest in funds that are backed up by, first loss from a DFI or any catalytic capital provider or first loss, also you have the guarantee minimum returns. What is return of the risky to the insurer or to the first loss provider. So I think those structures are very.
Thank you for that, Mr. Udwanu. A question to you, Dr. Aswani. As AVPA, what role are you playing in driving more visibility to investable opportunities in the social impact space that would be able to attract pension and sovereign wealth fund capital? Thanks.
So Precious, we've really been at the forefront of discussing the problem of funding social investments, and the fact that the old models of depending on aid and government funding are not going to take us forward. And this started off with a study we did about 3 years ago called the Landscape Study that's on our website, in which we showed how aid had declined by about 30% over the preceding 5 years. It's down to almost half what it was 5-10 years ago, and I think the trend will continue. So firstly, I think just to have people recognize the problem we're facing and the trends we're having to navigate. And then secondly, looking at the opportunity cost of doing nothing, making sure that we all understand the risks of some of these issues, like I mentioned before, youth unemployment, that has devastating risks to this continent. We miss out on a lot of things, the demographic dividend. By 2040, 25% of the global workforce will be African. How are we investing in making sure that we're not just developing workforce for Africa, but for the world? So things like that, I think, are super important. And thirdly, is also in bringing pension funds closer to understand more about what they're able to do, what their restraints are, and what makes more sense to them. So we've plugged into a lot of pension fund conversations. I think we're plugged into conversations with pension funds across all the 3 regions. And even at the conference in Nairobi in November, we have a full half-day session just for pension funds. And this further drives home the point of we're trying to make sure we can do what's best for the continent while making sure that the mandates of both pension funds, policymakers, and the demand side of the market are being met.
Thank you for that, Dr. Aswani. A quick round the table, closing shot. How do we move from conversations to action? One commitment you're making to make this discussion a reality for the next 24 to 36 months. What is one commitment you're making? I'll start with you, Mr. Kirungi.
I think it's easy for us to lean on the fact that there is a hunger for alternative assets. Yeah, like the structural tailwinds and everything is in our favor right now. But once again, it is the rightfully or rightly structured opportunities that will attract capital, right? And so it's just, once again, recognizing what it is the market is looking for and putting that as the priority, rather than what it is that, when I say the market, I mean the pension schemes, rather than what it is that is generally needed. Yeah, that's the reason why there's the gap. We are not speaking the same language, right? And so I don't think there needs to be any kind of commitment from the pension scheme side. They are hungry. They are looking for opportunities. Now it is for the rest of us to structure the right opportunities and bring it to them. And from there, like I've said, it's the tailwinds are all in our favor.
Thank you for that, Mr. Udwanu.
Okay, for me, and we have made commitment to move the allocation to up to 20%. It's not something that will happen in a year. It's a multi-year allocation, meaning at each point in time, as the pension assets grow, we will increase the amount of investment we make in the alternative space to that limit. And the funds in Nigeria our funds growing about 20% per annum, so that is quite a big TSI. I think over 4 years, I easily have that 20% in $1 billion in commitment to OpEx investment. I would like to see one more exit strategies and exit vehicles, because like I said, the challenge is liquidity and exit from existing funds. There are quite a number of us that have made investment and now like 7 year, and we're seeing limited exits. We also like to see more capital market type instruments that could accelerate exit and provide liquidity to pension funds. And generally more listings on the market. And I think that the more the capital markets on the continent, in Nigeria, in Nairobi, in Accra, are more liquid and they are more visits, then the pension funds can deploy, and they know that it's easy to choose the liquidity requirements of the member. And we like to see more collaboration between pension funds. It could be pool vehicles like in Kenya, also just open plans. One of what I think of in Nigeria is a pledge fund that is open-ended, that allows to crowd into investment on a case-by-case basis. So a pledge fund that invest in other private equity funds. However, they invest in large projects. So for instance, $300 million infrastructure pension funds can come to an estimate to invest up to $200 million in that particular asset, working with another PE fund or investment fund. So those are the things we like to see. Practical steps, increasing allocation. But what is more important is that the exits are short and the return expectations are met.
Thank you for that, Mr. Odwano. Dr. Aswani?
Yeah, so I think the one thing that we recognize that Africa has 54 countries, and each country has a unique set of needs. There's some kind of congregation of these unique needs, but generally we've got to better understand the needs of each of the pension fund managers in the respective countries. I think that's something we're going to try and do better going forward. So just like Mr. Kirungi has mentioned, in Kenya, the LPGP structure is not kind of the option preferred there. In South Africa, it might be a bit different. Then there are no trustees in Nigeria. So those are the nuances we need to just make sure that form of our substance, we are able to, at the end of the day, support this particular initiative in the right direction. That's number one. Number two, I think what's consistent across the countries is the need for catalytic capital. And AVPA commits to making sure that we are increasing the amount of catalytic capital available and the number of catalytic players available, and in particular, bringing governments into this conversation. So we'll continue to build on our catalytic pool funds and make as much available. So we work with partners across the world to try and see we can bring more catalytic capital into the continent. So that will do consistently. And then the third thing for us is try and see how we can transfer success stories across Africa, so we can learn from each other. So we're very fortunate to have a bird's eye view of the continent, and how do we quickly move lessons learned from one country to another. So part of what we'll be doing at the conference this year within the pension fund session is to bring some of those lessons across multiple countries, because I think that's how we learn quicker.
Fantastic. Thank you. Ladies and gentlemen, as we wrap up, what is clear from today's discussion is Africa's development finance gap is real and is urgent, but so too are the real opportunities to address these gaps. The barriers are not insurmountable. There are opportunities and solutions that can allow us to address these barriers so we can further fund a lot more of the impact sectors across Africa. The call to action is clear. Policymakers must create an enabling environment in order for long-term institutional capital like that coming from pension and sovereign wealth funds to be able to invest in development sectors across Africa. Fund managers and advisors need to design vehicles that blend fiduciary duty with long-term development goals. To the pension funds on our call today, and those listening, be bold. Commit to more and more investments in impact sectors that continue to drive resilient economies across Africa. Ladies and gentlemen, this is not the end of this discussion. As Dr. Aswani mentioned, we will be continuing this discussion in two forums around our AVPA conference. One is a panel discussion on the first day, which is the 3rd of November, where we will unpack this discussion and look at the role of pension and sovereign wealth funds in further driving investments across different impact sectors. But we're further dedicating a half-day session that is focused on really looking at practical pathways. We know the reality of the challenge on the continent. We know the potential of the untapped resources that exist. Now we have an even better understanding of how and why we need to structure the right instruments to be able to take advantage of the 1.6, 1.3 trillion odd available capacity on the continent. We invite you to join us at the AVPA conference, where we will further unpack this discussion. Thank you to everyone who has joined us. As mentioned, our conference runs from the 3rd to the 5th of November in Nairobi. We've got some partners that have come on board to sponsor the conference because they've recognized really the importance of future-proofing the continent, future-proofing Africa. And we urge you to join us. If you'd like more details on how you can join us, whether to register as delegates, pick up the conversation around the pension fund session, or certainly discussions around our catalytic put fund, we encourage you to get in touch with us with the details on your screen. Reach out to us. A huge thank you to everyone that took the time to participate today. Thank you to our fantastic panel for making this conversation a reality, and for taking the time to really help us better understand how we can leverage this available domestic capital on the continent. Thank you to you all, and see you soon.